Hello and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, Jame DiBiasio. If you value the program and our content, please give us a like and let YouTube know all about it. My guest today is Jason Tu, founder of MioTech, an Asian-based ESG Fintech that is helping portfolio managers and other financial institutions, as well as corporates, with ESG-related reporting, data, and services. I spoke with Jason about ESG trends, what's happening in Asia in particular, and the way that data is beginning to really make a difference. Jason Tu, welcome to DigFin VOX.
Thanks for inviting me.
Great to have you. You have been a leader from the technology side in ESG in this region for a while. What is going on with ESG in China, and how has COVID impacted that?
So MioTech is a technology provider focused on Asia Pacific. We started off in China, in the Greater China region. Now we have expanded into Southeast Asia. So back to your question, what we have observed in the past, I would say 2 years, is that there's a fast-track adoption of ESG. This is partly because of all the buzzwords you have heard in terms of, for example, supply chain disruptions, supply chain due diligence, and all the regulatory moves, for example, of SFDR, Sustainable Finance Disclosure Regulation in Europe, and also the regulatory moves in China as well. And there are more stringent scrutiny on data security issues, et cetera, and et cetera. So I think both from the supply chain perspective and also from the regulatory perspective, it has actually propelled a faster adoption of ESG in the region.
What is the reporting situation like? So in Europe and other countries, there are increasing requirements, whether it's at the exchange level or the corporate issuer level, to report data around emissions and other ESG related factors. Is it similar in China and Southeast Asia? Do they have their own versions of what this looks like?
Yes, they are very similar from the overall kind of ESG reporting standards. I think both, for example, mainland China and first of all, Hong Kong is for sure at the forefront of it. Mm-hmm. It's way ahead of the other jurisdictions in the region in terms of regulation, especially in terms of exchange regulation or exchange rules, like rolled out by Hong Kong Exchange. Having said that, if we're talking about exchanges, for example, in mainland China and also in Singapore, they have also been moving in reasonable speed in terms of making ESG disclosures mandatory. For example, this year or late last year and early this year, the Shanghai and Shenzhen stock exchanges has rolled out guidelines for companies to report as much as possible on their environmental metrics. And for example, on CBIRC, the
China Banking and Insurance Regulatory
Commission. Exactly. They have also rolled out guidelines. These are, notice that I've used the word guideline. Most of these are guidelines right now. So it's not mandatory, but at some stage I see it becoming, mandatory requirements very, very soon. And similarly in Southeast Asia, I would say, led by Singaporean government, its push is even faster and adoption is even faster on the regulatory side.
In your view, I mean, you're a technology provider to these to financial institutions. How fast is this pace of change compared to what you think portfolio managers think they will need? Are they getting enough information that from the investment side to be able to start making good decisions around risks?
First of all, right now we have expanded our business in the past 2 years. So we're not only serving financial institutions, but also serving corporates right now to help them collect ESG data and measure their ESG data. But on the financial institution side, I would say we've seen a lot more interest, and the interest has grown very rapidly in the past 2 years. At the same time, I think the asset managers or the buy side and sell side altogether are really, learning and teaching themselves to adopt ESG in a much faster way. Starting from 2021 and into this year in 2022, we've seen a lot of kind of mid-sized and even smaller size hedge funds becoming our clients, and that's a very good sign. Mm-hmm. And although some of the larger asset managers and asset owners, to them, their methodologies are more sophisticated. So they have their internal research team, they have their internal implementation across multiple business lines. Whereas, the smaller financial institutions like the hedge funds, their needs are simple. For example, LP reporting. How do they report to their LPs? Or compliance, regulatory compliance. How do they comply with, for example, the European reporting standards, disclosure standards, and or the new set of guidelines from SEC, for example.
ESG is a very broad term, right? Environmental, social, and governance, and these things can mean, I guess, they can be interpreted in different ways depending on where you are and what are the priorities of a given society. In your business, do you find that there's a certain emphasis on parts of ESG and not on others?
Yeah, a very good question. I would say yes or no. The yes in the sense that you can clearly feel the very strong trend, for example, on carbon emissions reduction and on clean energy, even with all the geopolitical issues that are happening around the globe right now. And countries are pushing forward their clean energy plans, their carbon emissions reduction plans. But having said that, since we're serving the finance community, both the finance and corporate, I do think there's a slight gap. So for financial institutions, I think they're adopting a more holistic approach to ESG, which means that although there's been focuses on environmental issues, the financial institutions also want to focus or also want to take a holistic view of S&G and social and governance part.
Yeah. What is the way that you collect the data?
One is from publicly available sources. And under this, we have, for example, extracted data from companies' reports, reported data that not only includes financial reports, CSR reports, but also any kind of disclosure the company has voluntarily announced into the market by themselves. And also, on the other hand, it also includes, for example, any public information that is available on the web or from news sources. And so this is the first category, what we call reported data, or overall speaking, publicly available data, right? So it's reported data plus what we call alternative data. And the second category is direct collection or sharing of the data by the company. And that's why we have built up our corporate service arm as well. So we serve corporates to help them collect ESG data. And there's a third dimension, and this is in complement to the first and second. If we don't have the first, the publicly available information, we would help, for example, financial institutions to engage corporates by using our software. But even if we try to engage the corporates, sometimes they're still missing data. How do we do it? We give a reasonable estimate. There's different or a variety of different methodologies to estimate the data.
Stakeholder management is a growing concept. I guess it's often put in contrast to, say, the neoliberal mantra of shareholders come first, second, third. But yet we still live in a financialized world where giant fund managers are still making decisions based on their value, traditional metrics around growth and profitability. So what has to happen for stakeholder values where a company perceives genuine need to not that it forgoes profits or that it goes against shareholder interests, but that it maybe moderates those because there are other interests? Is that actually happening? And what has to happen if stakeholder values are to become actually embedded in the capitalist system?
It has already happened for many years, and people probably just didn't notice that. Let me give you two examples. One is both in the capital market. One is that think about it, how many fund managers or shareholders care about dividend right now? A large number of companies go get listed without profitability, right? So there are various reasons behind it, but I'll explain later. And second of all, think about earnings release. If we were to dial back like 7 or 8 years ago, when I was still very active in the capital market doing all the trading, there were a lot of, for example, really betting against the earnings release, whether the number is going to be above expectation or below expectation. But is this still happening right now? No. Earnings release can hardly have a material impact on the company's their financial performance right now. Why is that? It's because we are actually, in the past, I would say a decade, we're transitioning, the capital market is transitioning into a more holistic view of the company. And it's not only based on, it's not dividend based, it's not purely on financial metrics. Bad behavior of a chief executive or some negative reputation of the overall governance team, or environmental pollution, or even some political incorrect kind of directions or comments can severely impact their stock price. So that justifies the overall transition into a more ESG aware market, and that's been happening over the past decade.
Yeah. The broad nature of ESG with multiple factors, particularly from the portfolio manager side, does that create an issue around greenwashing, where you might have all the data, but that data gets used to make justifications based on something that's, let's say, not environmentally friendly, but they've got good labor relations, but they're polluting the hell out of the, so how, I guess, effective is this broad church of ESG in terms of actually making a difference, particularly on the E part of it?
Well, greenwashing is a very big concern in the industry, I have to say that. But we are also seeing the ESG industry or ESG standards evolving, in the sense that if you look at the overall ESG structure, right, the bottom of it, or the fundamental the foundation of it is data. But on top of that, you have to have, for example, accreditation and assurance. That's also happening. Accreditation and assurance cannot happen without a globally recognized standard or a globally recognized, say, benchmark agency or rules.
Right. So the closer that we get to an international agreement around how we define and label these things, and the data that supports that, the easier it will get even though we have maybe some conflicts of not conflicts of definition, but conflicts of priority, I guess, in terms of what people should focus on as being the key risk within ESG. But you're saying that the data will, if we have this agreement on standards, then the data itself will allow us to make better decisions.
Right. So I think ESG is very similar to the transition into a more stringent financial reporting rule 20 or 25 years ago. So I think it's going to be there, and it's going to take some time if you think about the whole thing that happened to financial control in the early 2000s.
Let's finish up with talking about the tech itself. Obviously, data is the core of being able to make ESG work, whether you're a corporate or a shareholder or another service provider in this space. Where are we with the volume of data that can be categorized and applied? How if you were to give it a 1 is terrible and 10 is amazing, and you're a portfolio manager or a wealth manager or a hedge fund, what are you probably feeling right now?
I would say we were somewhere around 4 or 5.
4 or 5, okay.
But it's not a disappointing news. Yeah, so which means we're hardly there. We're not there in terms of the comprehensiveness of our coverage, in terms of data quality. We're not there. But what I can tell you is that we are also at our best. So with the best technology, we can achieve 405. That just tells you that without technology, you're probably 1 or 2.
What will be some of the technological innovations you expect in the next couple of years that will help improve all aspects of finance around ESG?
I don't think it's going to be rocket science, first of all. The technologies that are going to be helping ESG adoption, but rather it's going to be reliable technology that can enable faster and more secured adoption. What do I mean by that? If you think about, we've been providing information to financial institutions, but then the fundamentals of the data comes from the corporates. If you were to, if we were all together to enhance this data collection and help corporates, collect, analyze, and manage their data, it's a very big effort. The corporates don't have their ESG data. It's because they don't have the data internally.
Right.
99.9% of the corporates that we talk to, it's not that they don't want to do this disclosure, they don't want to share the data. It's simply because they haven't gathered all the data together themselves.
Right.
And this is really a big effort on the technical side, because as you correctly pointed out, there's greenwashing and there's reliability of data. So I think all in all, on the technology side, it's not going to be rocket science, like a new thing that we're going to invent, but rather is going to be the existing technologies, including, for example, data technologies like NLP, like knowledge graph, and also including, for example, infrastructural or what we call DevOps technologies, for example, on data security, and also across multi-tenant deployment, and also on data security overall setting, and also even including, for example, on blockchain, on ledger technology, and how to keep it. So I think we're very looking forward to adopting all these different technologies and helping the industry to enabling the industry to have a faster kind of transition into the ESG, more ESG aware kind of a world.
Well, look, Jason, thank you so much for taking some time to talk to me today.
Thanks, Jame, and I will look forward to more sharing and more collaborations in the future.